Investors and traders, welcome to the channel Market Chart Pattern. Today is 4th of November 2023, and I hope everyone is having a great weekend. In this video, we are going to take a look at the key US stock indices and our analysis and price projections based on the patterns that we have been looking at over the course of past few weeks and months. We will also cover the dollar index. We will also cover the debt markets using the U.S. Treasury bond futures. We'll mainly take a look at the long-term futures chart. So that's going to be the 10-year Treasury note and also the long bond future, which is the 30-year duration. This video is for educational purposes only, and it is not a financial advice. Let's start by actually taking a look at the dollar index. So we had the Federal Reserve come in last Wednesday. They kept the rates unchanged. One of the key things about the speech was, if you were listening to the Fed Chair Jay Powell speaking, the tone was not very aggressive towards raising further rates, and it was kind of dependent upon a number of factors, mainly the data coming up. So going back to the charts, one of the key things that we were looking for in this US dollar index futures chart, which we discussed quite a long time ago, it's not a regular feature in our videos, but I will make it a regular feature because, of course, the dollar has a huge impact. Everything needs to be taken into account. What's happening with the dollar is it's a key part as well. So moving forward, I might not cover it in each and every single video, but on a weekly basis, we'll try to take a look at this. So we had identified a strong resistance zone, which was anywhere between around 107, 107.35 to a little bit higher, around 107.60. That was because of the 1.27 to Fibonacci expansion and a smaller one around 107.60. And what the market has done is it came very close to these levels. We missed it about 35 pips. And the market has also formed a double top formation. And last Friday was a strong move lower in the dollar index. Now, with the weaker dollar, usually it's the precious metals, commodities, they benefit through a weaker dollar. And here the interesting thing is that what we have seen is dollar weakening, and we have seen the stock indices moving higher, and we have also seen the bonds move higher as well. So that's an interesting development. So this is why we need to keep an eye on the dollar index. Now, moving to the longer term weekly chart. Here, this is our longer term perspective. I had done a video about the dollar index. I'll try to put a link in the description about it. And the video discusses a long-term pattern and why we actually think that the dollar might have actually topped longer term. But it doesn't mean that the dollar cannot have rallies, like significant rallies. And this top, which has been put in place since last year, around September 26th of September 2022, it could be challenged as well. That possibility remains here. But the reason we were looking at this on the weekly chart level is basically there is a symmetry pattern which is much better visible on the monthly chart, which I'll show you in a minute. So we have these longer term market symmetries in here, and that is what the market has done. It has reached in terms of this market symmetry concept. Last year we had another one-to-one price projection ABCD right near that level, so we have a confluence of two longer term ABCD patterns coming together, one-to-one price projections. And further, what we have seen is that market, when it sold off, it came right to the 61.8% Fibonacci retracement of these lows here. So let me try to point it here like this. There we go. And it rallied 50% of this entire decline, and now it went into a which appears to be a pretty strong resistance based on the weekly candle. However, the momentum is still strong because the 20-week moving average is above the 200 day, excuse me, 200-week moving average. So the chances are that it's going to go and actually test the 20-week moving average around 103.75 level. So next week we are expecting further weakness in the dollar index. And of course, if this 61.8% Fibonacci retracement is broken, and then we are looking at much lower levels, because we'll have a potential 1-to-1 price projection A B C D, which could take it, which could see this trade, pretty low, perhaps around 94 to 92 region. We'll have to wait and see. But for now, this is what we are looking at. And just quickly taking a look at this monthly chart. This is really long term, and look at the move in the dollar in the early 1990s. It took about 10 years to reach a peak. Then it had a significant decline for several years, and right into the crisis, the global financial crisis around here. It put a bottom in April of 2008. And now what the market has done is it has risen for about 12 years, and the magnitude is same as the rally the dollar had put in since the early 90s, culminating sometime in early noughties, so around July of 2001. So based on this symmetry pattern, we believe that there's a good chance that the dollar might have put in a top for longer term. And but even if it has done that, look, when this top was in place, there were really sharp rallies around here. In fact, this double top formation took place, and only after that we had a confirmation. And what we have seen now is basically a decline right to the 61.8% Fibonacci retracement, and the chances are the dollar could still, rally from here as long as this 99 level is held. There's still a chance that maybe these highs get challenged, or maybe a little bit higher as well. But from a pattern perspective, we are also taking a look at these really long-term patterns. They are not for daily trading, of course, but something to observe, that we have this symmetry in this market. Let's take a look at the Treasury bond futures. This is the daily chart of 30-year long bond future, and as we have already discussed, from 107 level, which is 1.618 expansion of this entire range here, the market has rallied. So one of the key things that we were looking for as an early indication was whether the market it will be able to break this bearish symmetry which has been in place. So every time there's a move of this much magnitude in this entire decline, the market had actually sold off. And here what we have seen is a pretty good attempt to break out of it, and it formed a kind of a double, found resistance from this double top, which is not a confirmed double top right now, but there were either profit taking or some sellers waiting for it to get there, and we have seen a positive candle, but closing below this level. So now the next key level for us is 117.20, because that's going to be the 38.2% Fibonacci retracement of this entire decline here. And once the market is able to take that out, we have the 61.8% Fibonacci retracement and the 200-day weekly moving average hovering around 125 level. So that will come into focus. But what it means is that at least we are going to have a pretty good rally, and that is something which we had been anticipating, especially when we looked at the weekly chart. And in fact, earlier on we were looking at this 110 level really carefully, but the market actually went a little bit lower to 107, which was the 1.618 expansion. So this is what we are watching for. The thing to really notice is that we have seen the bonds rally last week. We have also seen the stocks rally last week, and that's a key thing to consider. Now let's take a look at the Treasury note future. So this is the 10-year. This market is even bigger than the 30-year long bond futures. Again, a similar thing which we quite similar to the 30-year bond futures. We think it could quite easily get to 110.12 level, and just on the daily chart, what we see is basically a bearish symmetric move. This one, it's right pretty much there. That's where it closed. It did attempt to break out of it right to this line that we had been waiting for. So things do look positive for really oversold market conditions as well in the bond futures markets. If we just take a look at the TLT, so this is the ETF iShares 20 plus year duration bonds here. We see a similar kind of picture to what we have seen for the 10-year and also for the 30-year long bond future. Here, a nice attempt to rally, and then right here around this level, we have seen some selling come in. So it does look like the bonds are beginning or starting a nice rally. And if people don't like the volatility involved in the futures market, then the ETF TLT might be a good instrument as well to take a look at. So this is something which really interesting, bonds rallying and the stocks rallying as well. So let's go back and take a look at the S&P 500. So in the S&P 500, this is the pattern that we had identified in advance, and what we have seen is market rally for a straight number of days last week. This is how much it had rallied before it found resistance. This time it has closed a little bit above it, but we would like to see a few more days of positive closes above this level. And of course, and also if it could just take out this high swing high out, that will be really nice for it. And if then if it is able to pull back and then move higher, then that's going to be a really powerful move out of this bottom, and it could indicate that perhaps we might have seen a pretty strong bottom right here. Now taking a look at the weekly chart, although what we have seen is after our ABCD pattern was met, just going back to the daily chart here, one-to-one price projection here, ABCD, right at the 78.6% Fibonacci retracement for a number of months that the market has been moving lower. But when we take a look at the weekly chart and just draw a simple trend line from the March 2020, these are the COVID lows, to the low in 10th of October 2022. So that's the 13th of October low right here last year. And look, this is where the market has been over the last couple of weeks, and last week that's where the low was, and we have seen a nice rally. So in fact, this trend line has not been broken and is still in place, so something to also consider. Now just a look at the quarterly chart, we see something similar, and just a rough trend line formation here as well. Let's take a look at the NYSE. This is the New York Stock Exchange Composite Index. This index contains about roughly 2,500 stocks, or top of my head, including the ADRs. So that's why we would also like to take a look at this one. And what it has done is it formed this, we can see there's this clear market symmetry here, right at the 61.8% Fibonacci retracement, found nice support, rallied into this resistance here, right at the 200-day moving average. And over the course of next week, we'll be watching this price action really carefully, whether it's able to take the swing high out, and if also this one pulls back a little bit and then resumes the rally, that is something which we would really like to see in this market. And let's take a look at the Dow Jones. And the Dow Jones is similar to what we have seen for the New York Stock Exchange Composite Index. Found nice support here around the 78.6% Fibonacci retracement of these swing lows here. A symmetric move right here. and the bearish symmetry in this has been of this much magnitude, and the Dow Jones has clearly cleared that level and went right into this structural resistance here, similar to what we are trying to look for other indices. Let's see whether it's able to take out the swing high next week, and if then it's able to pull back a little bit into this range and then resume its move higher. That's going to be a pretty powerful move of the bottom. But in fact, what we have seen now is also a pretty powerful move. And when we have a move like this taking place, we have to pay respect. Now let's take a look at the Nasdaq 100. So the Nasdaq 100 is the strongest of the major indices that we like to cover, and the reason is that it was not even able to fully retrace to the 38.2% Fibonacci retracement. It has had a nice rally. The symmetric move that we're looking for is roughly where it is trading, or where it closed last Friday. So the key thing will be to actually close above the 15,315 level. And then of course we have the swing high route right here. It's also a very powerful move. The momentum perspective, it closed last Friday above 220-day moving average, which is above the 200-day moving average. So from a momentum perspective, it's also strong. From the key pattern formation that we're watching for, the move has been just spectacular to the upside. So it looks pretty good around here. On the weekly chart, here we go. We can see a nice weekly candle closing right at the 20-week moving average. It might take a little bit of digestion perhaps, or maybe if things are so strong based on some data report, it could just move higher. But based on the patterns and the key levels that we had been watching for, the markets have actually pulled right into those levels. And then what we were expecting was for those levels or patterns to hold, which they did, and we have seen a pretty strong rally last week in these indices. Now let's take a look at the small cap Russell 2000. So Russell 2000, we like to take a look at it on the weekly basis. So it's been in a very long trading range, and every time it forms like a double bottom here, then it rallies, then it goes up to this upper range and then finds resistance. It has done it one time, two time, three time. From the bottom, it has done it one time, two time, and this is the third time. Eventually it'll break out of the range either way, or either to the upside or the downside. We'll have to wait and see. But this index is such a big range for such a long time. It's just mind-boggling to see what's going on in the small caps. Perhaps the reason is the small caps seem to be a lot more sensitive to the interest rates, because these are smaller companies which do not have the kind of fortress balance sheets some of the bigger companies do. So when there is an interest rate movement, if there's an expectation that interest rates are likely to move higher, then of course there is more pressure on the stock market prices for these companies, and maybe perhaps there's a sell-off when there's an expectation that okay, perhaps the Fed might not be as aggressive, they might not be raising the rates moving forward that much, or they might in fact lower the rates per the market expectations. Of course, what the market expects and what the Fed do, they are two different things. The stocks begin to rally because it would mean easing of financial conditions when it comes to the payment of the or servicing the debt through the interest payments. So this is what we are looking at in the key US stock indices. We also covered the dollar index in this video, and of course we covered the bond futures as well, because we like to take a look at all these things together, especially for the weekly video, which is a little bit longer. So we do apologize that the video is approaching about 20 minutes. But I think we have covered quite a number of things, given the fact that last week was a key week from a data perspective, because we had the Federal Reserve come out with the FOMC interest rate decision, and we also had the jobs report, which was also a really key thing. And the jobs report came out a little bit softer, on the softer side, and this is the classic situation where the bad news is good news, because we saw the stock market rally, we saw the bond rally, and we saw the dollar actually decline. So thank you very much for watching the video, and if you found this video of educational value, please do give it a thumbs up. And if you like our analysis, have a look at the markets using pattern recognition, Fibonacci retracements, price projections, expansions and extensions, then please do subscribe to the channel. And if you do, then hit that bell icon button, because that way you will know when the new videos are posted, so you will not miss anything. Thank you very much for watching the video. Good luck and good trading, and have a great weekend.